Hey, what is up, dudes and dudettes? Hopefully you guys are having a fantastic day as I am, and we're gonna do a small recap on what Jerome Powell, our lovely J Money, said in the FOMC meeting. So for those of you who do not know, we had a FOMC meeting. It's basically a meeting where the Federal Reserve do a press conference and investors trying to speculate and figure out when we're fucked in general. Sorry for my language. But in this FOMC meeting, we have some very interesting key points that were brought up in the questions in the main event, where J Money talk about the majority of, our interest rate is not going to hike this month, which is actually a little bit surprising for me, because when I look at the Asian market's inflation rate and all of the related inflation rate, I realized that, hey guys, the inflation statistics aren't correct in the United States. That means the actual inflation is actually higher than 7% as we were trying to say. And if we go look at the oil price, we know that we had a pretty good day today. And as I stand behind my estimates in my Russian video, where I talk about Vladimir Putin, my boy in Russia, at this point, it doesn't really matter if they're going to war with Ukraine or whatever the deal is. The oil price is going to keep hiking, okay? And then to what point it's going to stop, you guys might ask? Well, that's going to be for another video. But again, so the Jerome actually confirmed my theory on inflation is going to keep rising. What he's trying to say is, hey guys, and I quote, he said, we expect inflation to keep rising. And then what he's trying to say after that is the Fed is going to take necessary precaution, aka rising the interest rate, or aka fastening, accelerating the pace of stopping quantitative easing, which is tapering. So, and then he later on then said that the market is performing really well against whatever he's planning to do, because what he's really trying to do here is signaling to the market that, hey guys, it's right now the market is really value is really high, expectations are too high, and we're in a hyperinflation period of time. I don't want to be wrong about inflation. Like before I talked about transitory inflation, and then now we realize that the inflation is not transitory, and then it might shoot through the roof, and we have to take necessary precautions. And then the wording that he used in those meetings are a little bit interesting, where he says there are plenty of room for interest rate to increase. When the Fed chairman said there are plenty of room, he's referring to something regarding or on the range of increasing interest rate from 0.5% to about 0.75%. And if you go look at the benchmark for bond yields and benchmark for long-term mortgage rate, the federal fund rate, we actually have about 1.25% there. Okay, historically speaking, interest rates are really low under 1.25%. And then the Federal Reserve really want to increase the interest rate right now, because there's no other way they can combat inflation. And if you guys think, oh my God, the political movement is great, the Democrats are doing so well in Congress and the House and the government, the reality is the fiscal policy and the monetary policy are bumping against each other, like we talked about a month or two ago. And then right now, if Biden still decided to increase tax rate, that means on the contrary, what Fed is going to react to that is they want to hike interest rate even more. So then the fiscal policy side will back down. You see, there's still a little tension there in between the fiscal policy and monetary policy, but on the surface, they're saying they're not related at all. Another thing you have to understand is he talked numerous times about the Fed is basically he's stressing again that Fed is going to increase the interest rate in March. And then basically the next FOMC meeting is really important on February, which we probably will see a very interesting timeline. And then they're going to do a brief timeline estimate on when the consecutive rate hike is going to be on it, right? My prediction was January, March, July, and then they're going to do one in December, or they're going to do one in November. But in here, apparently they're not hiking the rates right now. They're saying that, hey guys, with COVID is going to ease a little bit, because they're taking Fauci's advice that February COVID is going to peak, right? COVID is going to ease a little bit, and then they sort of are giving us a breather. And from how he talks, if COVID isn't here, we're definitely increasing rate this month. But now we're saying that we're definitely going to increase rate on March. So what is it? What does this mean to the market? So he signals, Jerome Powell keeps signaling the market that the market valuation of where growth and everything is a little bit too high. At least it has to go down back under when inflation accounting has to break even. Therefore, as I predicted before, Nasdaq should be around 13,400. Okay, it should be even trading lower than 13,400. And then if you guys know that I have this chart where I drew this month ago, where I talk about Nasdaq should be around January to mid-February, it should be wiggling around these range here. Okay, and then as another prediction goes, is a lot of people are becoming ever increasing bullish, which I think is very, very interesting, and just I would like to kindly disagree with your assertion. And a lot of people think it's going to climb back up. I just think what's going to happen is if it climb back up, then it's going to be another big opportunity to buy puts all the way until the rate hikes on March. Because if the market keeps climbing up back to the old level, that means that at March, all of these volume has to be suddenly disappear or evaporated in the day of the hike, which is probably not going to happen. And if you go look at a lot of the disclosures, the 424, right, disclosure on JPM and a lot of banks, a lot of these nominal interest rate in banks' mortgages already started to increase. Therefore, we're anticipate that the market will do certain adjustment towards a downturn in terms of preparing for the interest rate hike. This is actually a good thing. For those of you who are long, that means we still have a 2 months before, 2 months to realize a crash. That it's like this. If the market keep going up, then in March the gap is gonna be huge. So if the assertion is here, okay, so if the market keeps going up like this, then in March, all of this volume has to be gone. This has to be gone by March. So the most logical explanation or the logical assertion of where Nasdaq is going to go is it's going to rebound, wiggle again, and it's going to go down. And then it's probably, as I talked to my father this morning, I said it should be somewhere around here. Okay, 12,800. And he doesn't believe me. He's saying that I'm stupid by not buying back in yesterday. And as you guys know, I'm still holding the short that I got from this day, which is actually a horrible idea, by the way. This is a learning experience that we know that if your portfolio, when everybody's portfolio is down by about 15 to 20%, and your portfolio is up by 40, it's time probably to realize some of those values. And I did liquidate my Rivian put. But other than that, I didn't really, take a quick profit on GME. So it was my bad. And again, in the next 2 months, approaching March, we are going to see the entire market shifting towards value and out of the meme stock basket. And it's extremely important that you do not FOMO back into those garbles. Okay, that's it for this video. And again, Jerome Powell is giving us a very clear timeline and a very clear guidance regarding where the market is going to go, or regarding when the interest rate hike is gonna happen. And he also talked about the Federal Reserve's balance sheet. So basically, somewhere around March, where the taper ends, that just means the Federal Reserve stop buying assets from the open market. That means there's going to be significant less cash in the open market, which probably will evaporate around 20% of the entire cash level in the market. And then after that, they're going to start to sell. They're not going to buy, they're going to sell their asset on their balance sheet. So when they start selling their asset in the balance sheet with the interest rate hike, we will see a dramatic volatility exhaustion or volatility push towards the downside. All right, see you guys on the upside. Good luck, have fun, smash the like button, and subscribe. See you guys on the upside. Pew, 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 pew. Bum, 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 bum. I'm going to make a remix and make that into an outro probably. And again, we still don't have an outro.